To discuss the global infrastructure build-out, let's welcome in our next guest now, Brent Burnett, Global Head of Infrastructure Real Assets at Hamilton Lane. Brent, so nice of you to join us. Happy Friday to you. I mean, there's so much we could talk about. So let me start with this. I mean, how is this whole re-industrialization of the United States and this onshoring narrative, and also, I guess, the war to some extent, like we saw with COVID, which is kind of accelerating the need to be self-sufficient, changing the way that we should be thinking about investing in infrastructure right now?
No, absolutely. Sam, Marley, thank you for having me. I was hoping it'd be a little bit better news in the market today, so you may not invite me back after today, but these are certainly relevant themes that you're touching on within infrastructure. I think, Sam, you hit on some of these points. If you look at the big global trends that are shaping capital formation today, it's AI and digitization, it's energy security and reliability, and we've seen that more so in the last couple of months with the war in Iran. It's resource efficiency, it's supply chain and logistics optimization. These are all fundamentally infrastructure-enabled themes. And so the need to build out these assets in order to improve these global conveyance systems that really move these economies is very acute today. And so I think you're seeing more investor interest as a result of that. This really is a golden age for infrastructure, given just these very strong macro themes that are driving capital formation. I think one of the other reasons why you see such strong interest in infrastructure today is a result of heightened risk around inflation. These are assets that tend to have positive correlation to inflation through their contract structures. They have good downside protection. They have strong total returns. So I think the benefit of the downside protection, limited volatility, as well as the inflation correlation benefits, in addition to the strong macro themes that are driving capital formation here, are why you're seeing such a renewed interest in infrastructure.
Yeah, I mean, and one of those huge themes, obviously AI, we've been talking about it throughout the show. And of course, with NVIDIA, coming next week, it's a constant conversation, but a lot of attention shifting to where these bottlenecks could be, where to find opportunity. And the ones that keep coming up are all tied to infrastructure, electricity, power, transmission. Is this also where you're seeing opportunity in trying to play this infrastructure? Or are you looking beyond the data center build out?
Absolutely, Marley. I think that's a great point, because this build out that's happening from the AI infrastructure side, it really touches many other sectors within infrastructure. You look at the power dynamic in the U.S. power market, as well as Western Europe and other parts of the world, very structurally short long-term power supply. Estimates of somewhere between 750 and 1,000 gigawatts of new power capacity that needs to be added in the U.S. just to keep up with infrastructure, or just to keep up with AI data center power use. So where's that going to come from? That has to come from renewables, that has to come from battery storage, that has to come from traditional forms of power generation. In the first quarter of this year, you saw upwards of $125 billion of CapEx initiatives announced from the major hyperscalers. They're leaning in hard to these data center assets that they need in order to deliver on this AI service model. And that creates increased constraints on grids. It creates transmission bottlenecks. Infrastructure capital, both public and private, can be positioned to solve some of those bottlenecks.
Right. So, Brent, if you are an investor sitting here listening to that conversation, I mean, and you're looking for diversification right now, where would you say are the biggest opportunities? Is it in energy? I'm also thinking about LNG, just given obviously what we've seen with the Strait of Hormuz as well.
Absolutely. I think energy infrastructure has long been a driver of the asset class, but the bottlenecks in that supply have been made incredibly apparent with this Iran war. And I'll give you an example, Sam. If you look at natural gas, for example, in the Permian, there are places in the Permian where you can't give it away. It trades negative, or you have to flare it. If you can move that to Henry Hub, you can get $3 per MMBTU. Inclusive of transport and regasification costs to deliver that commodity to markets in Asia and Europe should be $6 to $8 per MMBTU. And yet you're seeing the pricing in those markets be anywhere from $20 to $60 per MMBTU on a commodity that, if the infrastructure existed, you have to give away, or you can't give it away in parts of the Permian. So this infrastructure shortage, I think, is very real. The need to put more capital into energy infrastructure systems in order to provide better long-term energy security and reliability is being felt around the world. And I think infrastructure investors continue to look for opportunities there.
And as you say, it's being felt around the world while it's also simultaneously accelerating globally. Where are the parts of the infrastructure play that you think are being underestimated right now?
Yeah, I think there's a couple of places where we think infrastructure opportunities are being overlooked. One is in the waste management space. This is a space where it's not the most interesting sector to talk about, but people always need to move their garbage. People always need to be able to tap into clean water and utility resources. So this is an area where it's very hard to access, but the underinvestment in those sectors as well is becoming increasingly problematic for places around the world. And the multiple expansion that you can get by investing in those sectors is very interesting from our perspective. Smaller assets trade anywhere from 6 to 8 times, whereas more diversified aggregated platforms can be 12 to 14 times. So there's good entry points on those valuations. There's high cash yields through very protected assets, and there's the opportunity through for multiple expansion through more scaled platforms.
Brent, we might not invite you back, but we'd like an invitation to wherever you are. If that is a real backdrop, that deck looks very nice in the summer. We could throw a shrimp on the barbie. I mean, we don't even actually say that. You guys say that about us. But yes, we'll speak to you next time. Brent, thanks so much for joining us. Have a wonderful weekend. Brent Burnett there, Hamilton Lane.